What's up, folks? VA loan assumptions are a topic that we address very frequently. People are calling up trying to understand exactly what happens with the loan assumption. How can they cover the gap between the assumed loan amount and the sale price of the home, right? If these people have had the home for a few years, they have a lower interest rate because they got it in 2020 or something. They've got a 2.5% interest rate. Rates today are somewhere around the sixes. They want to get that assumed lower interest rate, which we totally understand. But the difference is the remaining loan amount might be $350,000, but it's now worth, call it 500. So people are coming up with that 150 grand. There have not been good solutions to cover that financing. So I actually found a resource today that's been there for a long time, but some things changed. And now we do have a good referral source to be able to cover up to what they call 90% CLTV, combined loan to value. So they look at the first mortgage and then the second in conjunction with the first related to the value of that property. Okay, so what they'll go up to is 89.99%. So it's about a 90% CLTV. So the assuming buyer is still going to bring in some money. They're still bringing in about 10%. But if there was a much larger, percentage that they would have to be covering in that gap, that can help a lot, right? Maybe it covers an extra 10%, or maybe it's 20%, and the buyer's bringing in 10%, and they have, maybe that's from their own reserve, or they have a gift from family. They're pretty flexible with sources, and they're not sourcing that deposit either, which is interesting. So if you guys are running into that assumption issue, I've said before, hey, that's kind of a black hole, guys. I don't have a solution for you. Now it looks like we do have a solution for you. If you're in that assumption and you need some subordinate financing to cover that gap between the assumed loan and the sale price, we've got something for you. Have a good day.